also
Good evening again, everyone. Can everyone see the screen, the PowerPoint presentation?
good evening. Yes, sir.
Yes, sir. All righty. So what we're going to do is today we're going to review the homework number 4. I'm not going to go through all the questions. I'm going to just go through those ones that were a bit challenged to, to one or more people. Then we'll do a quick review of the previous lesson, previous class, and then we'll start tonight's lesson. Okay, so the first item I want to look at is on section 1, true and false. Okay, question 4, with respect to DSRs, debt service ratios, when calculating the monthly contribution of a credit card, we use a percentage of, it says outstanding credit card balance, usually 3 or 5%. That is false. Okay, so pay attention to the wording because we use a percentage of the limit, right? The credit card limit, not the outstanding credit card balance. Okay, so so question 4, section 1. That was the only question I think that was a challenge. So I'm going to move now to section 2, question 7. Which of the following is or are not true? And the answer is on page 30, or this is covered on page 30 of your text. The total debt service ratio is the amount of your monthly mortgage or housing payment obligations. Okay, so that is the one that is not true. Okay, and again, pay attention to what it's saying, mortgage or housing. Remember, The mortgage or housing portion is your GDS, okay? Your gross debt service ratio, not your total. The total is when you add everything together, okay? Okay, so question number 8, we move to question number 8. Questions to ask yourself when examining net worth. So A is a question to ask, where does net worth come from? B is not a question we ask. C is a question we ask, is net worth reasonable for the client's age and lifestyle? And D, has net worth been increasing or decreasing? So it's A, C, and D only. And again, you can reference pages 29 and 30 for that. Okay. Then the final question in this section, section 2, when calculating debt service ratios, rent payments to the customer's landlord should be included if a lot loan or consumer loan is being granted, and C, excluded if a mortgage loan is being granted for premises to be occupied by the borrower. And B is correct. Again, if you look at page 32 in your text, B is correct because if the person is paying rent, the rent will not fall away if they're getting a lot loan or consumer loan. However, if they're getting a mortgage loan that is going to be occupied by themselves for residence, property, duplex, triplex, some residential property, the rent will fall away because the mortgage payment would click in, okay? So that's B and C only. Then I want to move on to section 3, fill in the blank, okay? That was pretty much well done, with the exception that more than one person, the fourth blank just says has the resources to pay. You want to ensure that you put in there has the financial resources to pay. Okay, so that is an operative word in there. No one lost points for leaving out financial, but I just want to bring it to your attention that they have the financial resources to pay. Okay. The next item we'll move on is to section 4, which is the case study. Okay. And in this case study, we looked at Hezekiah and Lottie Balfour. Okay. And the write-up is there on the screen. I won't go through it. So the next screen is the consumer loan printout, the loan account printout. And then the other one is the, excuse me, the mortgage loan printout. And you'll see I have circled there the current loan amount and the current collateral security value, because we need those to complete the net worth statement. Okay, so the current collateral security value is $644,500. It's the current collateral security value. Okay. And the current loan amount is $142,903. So the current collateral security value goes in the assets column, and the mortgage balance, principal balance goes into the liabilities column. Ready? The net worth is positive, but I just want to bring your attention that you see a highlighted real estate for, oh, sorry, 644,500. I think someone had put in there 679,500. We're looking at the current value of the premises, not the completed value, because the property has not had the apartment added on yet. Okay, so the current value is 644,500. not the completed value, okay? And the write-up, again, I put it in blue to highlight it, and I've made the first two words larger. So upon completion, right? So remember when we did the review of Martin and Sherry, we said we use the current loan amount and the current collateral security value, okay? That is when we're completing the net worth statement, okay? When we doing the LPV, it might differ slightly when we're doing the LPV or LLP which we'll cover later on. Okay, so just wanted to highlight that, and then let's go over to the calculating the TDSR. Okay, calculating the TDSR.
Mr. Nottage,
Yes, go ahead.
1 minute. Can you go back to that screen, please?
This one here?
No, the net worth statement. Thank you.
You have a question on it?
No, I'm fine now. I understood.
Okay.
Yeah, I may have missed that.
Okay. All right. So this was pretty well done, with the exception that one or more persons threw away anywhere from half a point to 1 point by not the section in orange to the bottom there, the credit cards, by not putting in the monthly amount in the credit cards. And remember, I said that the sections highlighted areas to be completed. So you'll be, so it's for your guidance. Okay, so don't throw away any points. Okay, in this case, it was half a point each for those two items. Okay. Any questions before we go on to review the previous lesson?
I'm good, sir.
Okay.
I'm good as well.
Okay. All right. Great stuff. Okay. So last class we had looked at the last 5 items of compari: margin, purpose, amount, repayment, term, insurance. Okay. And so I completed compari, which is the canons of lending, known as the canons of lending, sorry. Okay. Then we also looked at the credit C's method, and we briefly went through those, and we indicated which items were associated with assessing, and those that were associated with structuring. So the first 3 are assessment, the middle 3 are structuring, and the last 3 are assessment. Okay, when looking at an application. Then we looked at the big 3, which we said was common to the compari as well as the credit C's. So the first one was character. So character in compari as well as character in credit C's. Ability in compari, capacity or capability in credit C's. Insurance is your collateral security. So it's insurance under compari, it is collateral under the credit C's. So those are your 3, the big 3, or the main 3 items that you can use to make an assessment. Okay, even though we have all those other things in compari and all those other credit C's, these are these three your basic components. If you get these down pat, you should be able to make a solid assessment for a loan application. Okay. And so we have them broken down. So again, blue character for blue, green for ability, and supposed to be gold, but the gold didn't actually show up on the backdrop. So it's kind of like a bronzy brown color. So showing your collateral. So the three major thrusts of characters: employment history, credit history, net worth. Two key components of ability or capacity is debt servicing and debt service ratios or calculations, income confirmations and calculations, whether they be weekly, annually, different types of salary, bonus, rent. Okay, and if we were doing business loans, you'll be looking at the customer's financials. Okay. Then the four qualities of we looked at those, the four qualities of good collateral security. Then we look at a chart to compare, compare the top three items of compare, the top three, or most important, I should say, of credit C's. What is the main thought? So we saw that on character. The main thought was will pay, the explanation, willingness, and propensity to pay. Ability, capacity, the main thought is can pay. Insurance or collateral, what happens if they won't or can't pay. And then we looked at some scenarios where you can combinations for lending or not to lend. So if the person has good character, good capacity, and good collateral, we said yes, we can lend to that person. If they have good character, good capacity, but not necessarily the required collateral, we said yes, you should still be able to make a decision to lend or not. And that's particularly important for unsecured lending. You wouldn't do that for mortgages. Three, if the person has character and collateral, but they do not have the capacity, we said no and possibly maybe, and then I gave a little illustration of how we can probably turn a collateral property that someone had into a business venture, and therefore bring in more income, thus increasing capacity. So that's where the maybe came in. And then the fourth one, if they have capacity and collateral, but they lack the character, they have poor character, that is, this one of the people who ain't gonna pay, they won't pay. The outright answer is no. Okay, so there's no need to second guess that one. You just move on and say no. Right. So any questions on that?
No, sir.
Okay. All right, so today's lesson, we're gonna look at structuring, product pricing, collateral security types, in particular real estate. We're focusing on real estate. And then we look at documentation, types of documents used, storage. Chances are we'll get the first section completed hopefully tonight. All right. So again, we're looking at product pricing. And let's go to page 40 in our text. And these bullet points are extracted from that page. So we have different interest rates for different clients and different credit facilities due to the variation in risk associated with each transaction. You recall last class, I think it was last class, or the last chapter, we were introduced to TLC and PACT. Okay, TLC and PACT. We're going to look at take a deeper dive into particularly PACT tonight. Okay, so different interest rates for different clients or customers. Remember, we said customer risk was one of those items in TLC, in the C and TLC, and then TLC deals with the product. So different credit facilities do the variation in the risk associated with each transaction. So, so we've come back to those 2 points. Okay, so let's start with TLC, the overall product risk, the type of loan risk. Again, whether it's a consumer loan, mortgage loan, commercial loan, and then of course then you have some other branches of your consumer debt, overdrafts, credit cards, and then from on the business side you have your letters of credits or documentary credits, right? So the type of loan risk, the liquidity risk, which has to do with how much money you have to lend or allocate. Well, first of all, how much what your portfolio makeup is, whether you're gonna what percentage of loans you want your portfolio to be made up of, what percentage you want mortgages, business loans, etc. Okay, so given a simple example, I think I may have given a similar example that I'm about to give when we first talked about this. So you may have a loan portfolio of overdrafts, credit cards, consumer loans, mortgage loans, and so you may say, well, I will do 5%. I'll do 5% overdrafts because we really don't want to have too many overdrafts. So 5% of our total portfolio will be made up of overdrafts. Then we'll have, probably 15% or thereabouts in credit cards, another 20% or even probably 50% in consumer loans, because consumer loans bring in the bulk of your money, they quick turn around and they're high interest rate. And then of course the balance to make up the 100% would be your mortgages or business loans. Okay, so the first thing is what your product base is made out of. What is the composition of your portfolio? And secondly is how much money do you have to lend? So if you have $100 million to lend, you will allocate, if in the case of the credit cards, where we're probably lending about 15% or 20%, whatever it is, you would use 20 million. And then of course if you're using 50%, there'll be 50 million of the 100 million. Okay, and so on. And of course, the customer risk is the third risk associated with the product. Okay, because we're looking at product pricing. Okay, and you have to look at the risk that the customer poses to you. Okay, so that's where PACT comes in. Okay, and so PACT, the P stands for the purpose of the credit facility, what the money is being borrowed for or going to be used for, the age of the client or the business. That is, well, first of all, the person has to be legal age. And secondly, you want to lend to someone who is already retired and have no substantial means or no means of repaying the loan or do not have the ability to repay. There's some people who have reached retirement age who can, who have the financial resources to pay back a loan. But those are banks or financial institutions are very careful in lending to people over the age of retirement. Okay, retirement age or over. And then of course also the age of the business, how long the business has been in, or is it a startup? So if it's a business startup, you may find that the interest rate on that may be a little more because the business has no history. So the interest rate on that might be higher as opposed to business that's probably been around 15, 20 years or 50 years, you know, and is now being managed probably by second or third generation family or business, a group of business people. Okay. So that'll be like your Kellys and those kinds of businesses, H. Pritchard's, John Bull, those kind of businesses who've been around for a little while. Okay. So their interest rate will be lower than a startup, someone who's starting up a business. Also, the collateral offered must be considered. So the quality of that collateral, the ability to be able to liquidate that or realize your security as quickly as you can plays a part, and also that it is one that doesn't fluctuate often in value. You want to consider that would be your prime. So again, you apply your four the four qualities of collateral security. And then of course the term of the facility also determines the pricing. So normally if it's short term, the interest rate tends to be higher as opposed to, say, a mortgage or a business loan that is longer, where the interest rate is lower because over a longer period of time, you'll make more money on this customer simply because there are more years, 10, 15, 20, 25, up to 30 years or even more on a mortgage loan or even a business loan, as opposed to consumer loans, where I think most of them top up at 10 years. I don't think anyone goes beyond 10 years. And if they do, it is not kind of industry standard. But the shorter the term, you want to get your money as quickly as possible. So you have that higher interest rate to make more money in a short period of time than with a business loan or a mortgage loan. Okay. So we go back to our page 40, go back to that our note on this, how banks determine product pricing. Again, interest rates for different clients, TLC, we just covered that, and different credit facilities or products is packed. And again, due to the variation and risk associated with each of the various transactions. Okay. So what are some of the considerations? Well, there are about 5 considerations. So the first one, the nature and value of the collateral. We just talked about that a bit. The dollar value of the transaction. So the size of it would determine, again, normally consumer loans are the dollar values are smaller. The dollar values of mortgages or business loans tend to be larger for the most part. So again, they would play a part. Okay. The viability of the business transaction. Okay. What is how viable it is to deal with this particular application. So for example, you have consumer loans, you have your salary deduction, and those are mainly for consumer durables. Some of them may be for shopping, vacation, medical, but if they are covered by salary deduction, they pretty much run on their own. And you say that you look at the loan. Yes, this is a new car loan, for example, and we have that spread over 5 or even 7 years. This looks viable. The person needs the vehicle. They can pay it back, et cetera, et cetera. And so and also whether or not it falls within your the outlined purposes for which you may lend. Okay, so some financial institutions are limited in terms of the purpose for which they can lend. So, for example, the Bahamas Development Bank cannot lend someone to buy a car for their personal use. They can lend to them to buy a car for their business. Okay, and then they have the different types of businesses that they can lend to. So the Bahamas Development Bank does not lend to any and everybody. Okay, it's more business focused, agriculture, and economic development focused. Okay, and then of course the sufficiency of cash flows. How this goes back to ability, the client's ability to meet the payments. Okay, whether it's a business or it is a personal consumer venture, right? So whether it's an individual or business, do they have the cash? How is their cash flow? Again, that's tied to the ability or capability or capacity. If you're looking at credit Cs, okay. Then of course the additional earnings that you can get from doing these loans. So, for example, someone may have a business may have overdraft facilities or letters of credit. So there may be an opportunity for the bank to get foreign exchange, make money from doing foreign exchange, from the persons having to buy, transact business abroad. So doing wire transfers of foreign currencies, or even the selling of foreign drafts. Okay. Then of course there are commissions on certain transactions, or administration fees. Then there are ledger fees or account fees that can be made. So, for example, if the business opens up, that's covered under payroll services. But ledger fees, service fees. So on a monthly basis, all banks or most financial institutions charge a fee for using the accounts, even savings accounts. So it's not just checking accounts, it's savings accounts. These are charged. And of course, payroll services, if you this is kind of diminishing now with financial institutions, where the company would issue checks to its employees, and the employees would cash those checks or at that bank or at other financial institutions. Nowadays, you have direct pay, so the payroll services aspect is falling away. And certainly, if the central bank has its desire, check services, using checks to pay for services, will fall away certainly by the end of 2024, which is what the present governor of the central bank, that's his target. Okay. So if any questions on that before I move on to the next paragraph?
No, sir.
Okay, no questions? Okay. So let's go to the next paragraph that talks about why banks are in the business of lending money. They're in the business of lending money because they want to benefit from the net interest income derived from the spread between the interest paid to depositors and interest charged to borrowers. Okay, so when depositors come and put their money in the bank usually pays interest to those depositors, although in recent times it's been very minimal. And the interest and again, so it's the difference or the spread between interest paid to depositors and interest charged to borrowers or borrowing customers. Okay, it is also to be considered other costs such as overhead, salaries, etc. These must be covered. Hence, careful consideration is given in pricing loans. Okay, and thirdly, there's the need to remain competitive. So that will also impact the pricing. So no matter how, well some banks take the risk and they'll be probably like an industry leader, and they'll say, okay, well, we'll go up by 1% on our consumer loans, because if they feel that the public has that appetite, and if they if their loan book maintains, everyone continues to go to them for loans, notwithstanding that they've gone up on their say consumer loans by 1%, and they still have the same level of business, or they have increased business, that will kind of trickle down to the other players in the financial services sector, and they too may increase their prices. Okay. However, if a financial institution increases there's a slowdown and people come to them, then they may lower the go back to lowering the interest rate. And how some of them do it is they won't just lower it so that'll be so obvious, oh, they went down because ain't nobody going to them. What they'll do is they may have like some sort of a car show or loan show or whatever it is in the mall or in some auditorium, and they'll say you get special rates to get brand new cars and whatever else it is. Okay, so they'll offer these pretty low, much lower than they were before, to get you back in. To get clients back in, and then they'll make some adjustments so that their interest rates across the board do not reflect that 1% increase that they initially did. So that would be how financial institutions, if they are smart, will walk back any increases that have negatively impacted their ability to attract businesses. Additional business. Okay. So what are margins or spreads? Okay. Well, as we looked at the first in the previous slide, it says banks and business derive from the spread between interest paid to depositors and interest charged to borrowers. Well, the first definition of margin or spread is a relationship between the loan and deposit interest rates. And again, that is kind of falling away because deposit interest rates are so low. The normal peg now, the normal peg now is the cost of funding, which we will look at in a few minutes or moments, hopefully. Okay, so you have the relationship between loan and deposit interest rates. Said another way, is the difference between those interest rates on deposits versus those on loan products. And then, as I mentioned, I was alluding to just a few minutes ago, the difference between the bank's prime interest rate and the loan product interest rate. So this one, I think this is a complete fill in the blank, which is important, and which is really where the banks or financial institutions are headed nowadays, or are dealing with nowadays, with regard to margins or spreads. Okay, so the main definition or illustration, or whatever you want to call it, of a margin or spread is this third point: the difference between the bank's prime interest rate and the loan product or interest rate. Okay. Any questions on that?
No, sir.
No, sir.
Okay. So we just looked at TLC and pact. So again, TLC, type of loan risk, L, liquidity risk, C, customer risk. And then we looked deeper on the customer side of that risk, and by using pact. So purpose of the credit facility, age of the client or business, the collateral offered, and the term of the facility. And again, they affect all of your loans. And you see there behind the curly bracket, business loans, consumer loans versus mortgage loans. So you'll find that mortgage loans, again, tend to have a lower interest rate than business loans or consumer loans. Okay. So we're going to look a little further into pact and the relationship of interest rates with each of these. Okay, so I want you to, we're now on page 41. Okay, so page 41, you can utilize arrows and for up or down. So when we look at P, the purpose, for consumer loans, you find because the risk is usually higher, the interest rate tends to be higher. So that is why the arrow is pointing upwards. Okay. So on purpose, for consumer loans, the interest rate is usually higher because the risk is higher. For the mortgage loan, would the arrow point upwards or downwards? What is your opinion on it?
Downwards, sir.
Downwards? Yes.
Yes,
okay.
sir.
Because it's less risky. Again, the interest rates would tend to be lower. Okay. The age of the person, the older the person or security, the higher the risk. Okay, because if a collateral security is old, is aging, there's depreciation, there's wear and tear. There's in the case of a car, you're gonna have the end of his life, his useful purpose, et cetera, et cetera. So age, the older a person or the security, the higher the risk. How would you put that arrow, up or down?
Up, sir.
Up, okay, all right. All right. The more established and healthy the business, the lower the risk. Where would the arrow go?
Down.
Down.
Yes, it would point down, okay? The more established and healthy the business, the lower the risk. So again, you have the interest rates being lower, okay? So on the consumer loan, what about collateral? The better the quality, liquidity, et cetera, of an asset, the lower the risk. Anyone with the arrow?
I would say it'd probably be down.
Down, okay, so two of you are saying down, okay? Yes, down. Okay, so the better the quality of the liquidity, et cetera, of an asset, or security or collateral security, the lower the risk. Okay. However, if there's no collateral, such as when we do with salary reduction loans, you'll find that the arrow will go up. The arrow will be pointing up. Okay. So normally, if a consumer loan is collateralized, the interest rate tends to be lower. If it's not collateralized, it's unsecured, the interest rate would be higher. But in this instance, for consumer loans, you're looking at the better the quality, liquidity, and a lower risk. So in this instance, the consumer loan gets its first downward facing arrow. What about on the mortgage loan side? It says that the better the quality or liquidity, et cetera, of an asset, the lower the risk. Where would that arrow point?
Would it be down, sir?
Down, yes, okay. Okay, similar to consumer loans, okay. Term, T term. The shorter the term, the less risky. However, you want to maximize your return in the short term. Okay? So usually short term, remember I said, because it's short term, you want to make as much money as possible. Since it's a relatively short term. So what would be your opinion on the arrow pointing upward or downward?
Upward, sir.
So, sorry,
Up.
you
Upward,
broke
sir?
upward? Yes, okay. All right. Okay. And what about on the mortgage loan side?
It'll be down, sir.
Down. Okay. Okay. So on the consumer loan side with PACT, we have 3 arrows pointing up. So the interest rates are higher. On the mortgage side, we have the interest rates, all 4 arrows pointing downwards, okay, indicating that mortgage loans attract lower interest rate in all 4 of those categories of PACT, okay. And when we consider commercial loans versus personal loans and mortgages, and again, we are lumping personal loans and mortgages, usually higher than mortgage interest rates. On the commercial loan side, they're shorter term, the greater equity injection required. They have a greater level of monitoring and controlling required. As I mentioned in the previous class, business loans are reviewed annually on an annual basis, much like overdrafts, because of they're so risky rather. Okay, and then of course in your book it says ask the question why, because the risk is greater for business or commercial loans than for personal loans and mortgages. So we have personal loans. Well, let me start with mortgages. You have mortgages that are because of the amount of scrutiny and assessment being done on it, and because of the underlying collateral security, they tend to be less risky. So their interest rate tends to be the lowest among the interest rates of all the different products. Personal loans tend to be higher than mortgages, again, because they're more risky. And then when you get to business or commercial loans, possibly with the exception of the Bahamas Development Bank, where the loans are all under 10% or so, I think. Business loans or commercial loans tend to be higher priced, and so the interest rate is higher, or they may have a competitive interest rate, but then the fees that they tag on are considerably more. So they make so that their pricing isn't just limited to the interest rate, but is also extended to some of the other costs. For example, on the commercial loans, because they're reviewed on an annual basis, every year they attract an annual fee. Okay, whereas with personal loans and mortgages, you'll pay that commitment fee or facility fee, whatever you call it, upfront. It's a one-time fee. Okay, so on business or commercial loans, while you may find some business or commercial loan interest rates lower than personal loans, the pricing of that product is higher because of built-in fees and commissions, etc. Okay. Any questions on that before I move forward?
I'm good, sir.
I'm good too.
All right. Now on page 42, we already did that we did that exercise earlier in an earlier class, so I won't go through that. Again, that's the one, purpose and term relationships. So we've already gone through that. So I'll go straight to page 43. And we look at a business loan or commercial loan, and we begin to see why the interest rates, excuse me, the interest rates, and well, let me just say the product pricing, okay, because product pricing is interest rates and fees, okay. So we'll begin to see why I have said that they tend to be higher overall than consumer loans and mortgage loans. So we're looking at this example given in the book, which is Cable Beach Manufacturing Company Limited. Okay. So Cable Beach Manufacturing Limited. So we have several columns there. The first column to your left is the facility amount. The next is the interest rate, the gross interest, the cost of funds rate, that's COF, cost of funds, funding costs, annual net revenue, your margin or spread. In your book, you may have ROA, return on asset. I prefer to use margin or spread. So on the next printing, we will that will be amended. If it's not already amended in your book to margin, it'll be amended to margin / spread. Okay. So the facility amount, we see that it's going down to the next row. It's $2.9 million. The interest rate is 8%. And then it tells us what the gross interest is. So 8% of 2.9 million is 232,000. Okay. The cost of funds, it lets us know what the cost of funds are. And the cost of funds is 3.1%. And the cost, so 3.1% of 2.9 million is 89,900. The annual net income, you will subtract the funding costs from the gross interest amount. That'll give you 142,100. And then to get your margin or your spread, you subtract your cost of funds rate from your interest rate, and you get 4.9% as your difference. Okay, so let's just go through each one of those so you can see. So again, we're borrowing 2.9 million. This company, Cable Beach Manufacturing Company, they are borrowing 2.9%. The bank or financial or the lender is going to lend them it at 8%. Again, 8% of 2.9 million is 232,000. We're given that the cost of funds rate is 3.1%. So 3.1% of 2.9 million, again, is 89,900. The annual revenue, we get that by subtracting funding costs, 89,900 from 232,000. That gives us 142,100. And to get the margin or spread, we subtract the cost of funds rate, COF rate, from the interest rate that is being charged by the bank, and that gives us 4.9%. Okay, to work out a chart like this, you would have to at least have two of these items, either the interest rate and the cost of funds, or the interest rate and the margin or spread. Okay, so if you were given 8% as your interest rate and your margin spread at 4.9%, you would then subtract 4.9 from 8%, and that'll give you your cost of funds rate of 3.1%. Okay, so it's a mathematical formula. Any questions on that?
Yes, Mr. Nordich, I'm asking for a friend. Will this be on the exam?
Pardon?
Will this be on the exam, sir? I'm asking for a friend.
I didn't quite get that.
Will we have one of these on the exam?
Yes. Yes. In fact, you'll be getting one for homework tonight.
Okay, so we have the interest rate and the spread. You would then subtract the spread or the margin from the interest rate.
And I'll give you your cost of funds.
Cost of funds.
Okay, so the cost of funds is 3.1%. Or you may be given your interest rate and your cost of funds, and you need to determine your margin or your spread. So again, you'll subtract the 3.1 from the 8, which will give you 4.9. You see?
So technically speaking, you will more than likely be given the one that is the greater, in this case, the interest rate, and just try to figure out the COF of the margin spread.
Well, I mean, you could be given you could be given the COF rate and the margin and the spread. So all
Just
you'll
add
say
it together.
add those two together. You see, because it's mathematical. You have to be given at least two of these. You have to be given at least two of these in order to work it out. And you will be given at least two of these to work it out. We're going to do another example in a few minutes. And like I said, you'll also have one for homework.
Okay, thank you, sir.
Yeah. All righty. So, so the facility amount is 2.9 million. And so we've worked out the interest rate. Okay. The next line is the charge on the new facility, and we are charging them 1%. Okay. And you see that everything else is grayed out except annual net revenue, because we charge them that 1% every year. Okay. So 1% on 2.9 million is how much?
Say that again, sir.
1% of 2.9 million is how much? To get an annual net revenue for that line, the next line, the charge on new facility at 1%.
29,000.
29,000. Anyone get anything different?
29,000.
29,000. Okay. Alrighty. So so the last row, okay, that says annualized projections. You just simply add. Those are your totals. Okay. So for the interest, okay, you just bring down the 232,000. That's a total interest that you're going to get on that facility, on that loan. Okay. Cost of funding. Your cost of funding doesn't change. That's 89.9. Well, 89,900. Okay. Then of course your annual net revenue. So you're making interest net. You're making interest on this account. So you have your net interest of 142,100. Okay, and then you also have a fee on this account of 1%, which is 29,000. And when you add those two together, what amount do you get? Right in your book.
171, 100.
Yes. Okay. 171, 100. Okay. So that's how we work. That's how we work that out. Okay. So let's look at another example. Okay. So let's do this one together. Okay. So we have a number of missing components. So we have this person ABZ Furniture Company is borrowing 1.75 million. The interest rate is 10.25%. What in dollar value? What in dollar value is 10.25% of 1.75 million?
179,375.
Okay, 179,375. Okay, great, good stuff. Okay, so we are told that our cost of funds rate is 4.75. So our funding costs, how do we determine our funding costs? The dollar value of our funding costs?
4.7525.
So 4.75 of 1.75 million.
$83,125.
Correct, very good. 83,125. Everyone sees that? $1.75 times 4.75, that's our cost of funds. Okay. Now the annual net revenue. How would we get the annual net revenue?
The gross interest minus the funding cost.
Yes, okay, so gross interest minus your funding costs, and that'll give you how much?
96,250.
Correct, 96,250. Okay, how do we determine our margin or spread?
The interest rate minus the cost of funding rate,
Okay, and that
which
gives
is 5.5.
5.5. Excellent, great stuff. Everyone sees that?
Yes, so
Okay. So we go down to the next line we have there. Oh, that's given us charging a new facility 1%, 17,500. Okay, that's given to us. Annualized projections. What goes in that column? The first column for gross interest. Annualized projections.
179,375.
Correct. And then funding costs will of course be 83,125. Okay. And what is your annual net revenue amount?
$113,750.
Okay. And how did you arrive at that?
The 96,250 plus the 17,500.
Very good. Excellent. Okay. So everyone sees that now? At first, it could look intimidating, but it's laid out this way to show your progression and how you can determine the cost of funding on a client. So in fact, some financial institutions have a system similar to this, where they do this for all of their facilities for the client. So the client have an overdraft or whatever it is, and so they'll just have a column for the loan or loans if they have more than one loan. They'll have it for the overdraft facility, probably the what you call it, the, they may have some other type of facility, say letter of credit, for example. They may have a letter of credit, so you can show what you're gaining from each of these facilities in terms of whether it's interest income, whether it's commissions, fees, etc. And then you'll just have, you'll just have more than just this here. It'll be several more rows. And then of course your totals will be your grand totals at the very bottom, which you'll add up all of your gross interest, subtract all your funding costs, and then add up your annual net revenue for whatever the number of facilities are. So the better client, so you can see how profitable a client is to you. So if they come to you and they say, listen, man, that 10.25 is kind of high, an interest rate on this $1.75 million loan, could you reduce that to say 9.5? So what the bank will do is the bank will look at some of the other facilities and see where they could get they can make up for that loss. So they may say, okay, well, we'll go down to 9.5, but the charge on your facility, instead of being 1%, will be 1.5%, or even 2%. Okay, so the bank will look for ways to try to make up for the loss. Now, if it's a really good client and you don't want to lose them, and you get the feeling that they're probably shopping around, then you may reduce it to 9.5 and leave everything as it is. Because if they're a very profitable client, it is not worth the risk losing that client if they've been profitable and they've been paying their facilities well for the time that they've been with you. Okay, so so you may increase the interest rate or the fee somewhere else, or you may not. Okay, so that'll be an executive management decision. That'll be their call. Okay. All righty. Any questions on this? Or
Mr. Nottage, this will be uploaded to YouTube, right?
sorry?
No, I said this particular class will be uploaded to YouTube, right?
It should. It should be being recorded. Yes.
All right. I think I got to spend some more time with this.
Okay. But if you have, let me just make sure it is. Okay. But if you have, if you have difficulty with it, because like I said, you'll have one as a homework assignment. You could always reach out to me and I'll get back. I'll see what we can do to help it become more clear. Okay.
Yes, sir. Thank you so much.
Okay. So let's move down to page 43. I won't get into maximizing the annual rate of return. That's a little kind of complex, so I won't get into that. I'll reserve that for the advanced lenders. Okay, so usury rate. What is the usury rate? Okay, the usury rate is an interest rate that is greater than the maximum rate that should be charged. So by law, financial countries have what they call the usury rate. And in the Bahamas, by law, you're not supposed to be charging a customer more than 20%. So 20% is the maximum interest rate that you can charge a client in the Bahamas on a facility, a credit facility. Okay. The usury rate is an exorbitant or unlawful rate of interest. And the usury rate is the act of lending at an exorbitant rate of interest. Okay, so you just need to know that the usury rate is a maximum rate that should be charged. In the Bahamas, it's 20%. That's the maximum that can be charged, 20% in the Bahamas. And that is an exorbitant or unlawful rate of interest. So it is covered by law. Okay. So we're about to get into collateral security types. And we're going to be looking at the real estate appraisal. So before we do that, are there any questions? No questions?
No, sir.
I'm good, sir.
Okay. Okay, so let's look at collateral security types. Okay, and so we're going to be looking at the first thing we're going to be looking at is lending values. Okay, well, the role of collateral security, we're going to be looking at the role of collateral security. We're going to be looking at lending values, equity, real estate appraisals is 3 types, with cost or replacement value being the most common in the Bahamas, although you'll find that there's been some pressure being brought to bear on financial institutions to use the sales comparison approach, even though we do not have a sales registry in the Bahamas. We'll talk a little bit about that when we get to that section. Stamp tax, VAT, and other cost calculations, legal documents. We won't deal with that tonight. There were some laws that were recently enacted. I think in July, that came into force in July. And so I'm still waiting for my legal contact to confirm how those changes to VAT and stamp tax may affect calculations, cost calculations for legal documents. So if we don't cover that tonight or Tuesday, we will come back and cover it at some point in time once I get that confirmation. Okay, but the information in your book is outdated because VAT did go down by 10% to begin with, and subsequent to VAT going down by 10%, like I said, there was some legislation passed that affects real estate transactions in the Bahamas one way or the other. Okay, if you look, if you went and you Google it, and some law firms who print information and some real estate firms, you'll find that there's a difference of opinion on how it's to be calculated. And that's because the lawyers were anticipating these changes, and the real estate people were not. So there's a little bit of confusion. So I wouldn't look at that. If you have to deal with a loan application that involves real estate, you'll have to be guided by your in-house lawyer, legal team, or your company's your financial institution's attorney of record, for them to give you advice on calculating costs in the meantime. Okay, so until it's cleared up, you should consult with your bank's attorney or your financial institution attorney, rather than looking to see how it's calculated on online, okay, by Google. So it's for that reason I have postponed, or will postpone, looking at stamp tax and VAT calculations on legal documents, in particular the conveyance, okay, the conveyance of real estate. All right. Then, of course, we will look at the, as part of the appraisal, we look at risks of overbuilding, of a client overbuilding, the risk to the bank or the lender, and the risk to the owner or the borrower. Okay. So if we go to page 44, I've broken it down in a point form here. The role of loan security. So that first paragraph, all forms or types of credit represent risk to the lender. Okay, so every type of facility that your financial institution has, consumer loan, credit card, overdraft, business loan, mortgages, whatever it is, all types of credit represent risk to the lender, the financial institution, or the bank. Okay, I'm using those three terms interchangeably. Okay. Secondly, no risk can be entirely avoided. You cannot eliminate risk. You're going to have some sort of risk. Okay. The most that you can do is you hear this word bandied about, mitigate risk. Okay, that means minimize it. So that takes us to our next point. Okay, so lenders seek to minimize or mitigate the impact of inherent risk and to justify their lending decision by obtaining some form of safeguard, that is collateral security. And again, under Campari, it'll be insurance, and the credit sees it's collateral. Okay. The security that is taken by these financial institutions will act as a backup or secondary source of repayment. Okay, that is if the borrower is either unwilling or unable to repay. Remember the main thought, won't or can't pay for collateral under the big three. Well, this is where that comes into play. Okay, so the borrower is either unwilling or unable to pay. We will then look to the collateral security as a source of repaying our debt in full or in part. Okay. So the second paragraph says the need to protect the lender relates not only to the character or integrity of the borrower, but also the possibilities to events and occurrences beyond the borrower's control. These could include general downturn in the economy, theft, vandalism, fraud, mismanagement, strong competition, new technology, regulation or legislation, currency evaluations, consumer tastes or preferences changing, and a myriad or a list of other things that could result in the borrower's inability to service or repay the loan. Okay. The last paragraph, the level, type, and value of the collateral security taken will depend on the lender's interpretation of risk. Excuse me. So we start again. The level, type, and value of collateral security taken will depend on the lender's interpretation of risk for each specific transaction and will be directly related to the value of the loan requested and the level of comfort the lender requires. Okay. Any questions on that before we move on to looking at the actual lending values and lending value ratios? No questions?
Okay.
Okay. All right, so let's look at page 45, the top of page 45. Okay. So it says here, lending values. Lending institutions will grant loans against real estate using a lending value ratio. This ratio is the loan to asset value ratio, which is either the loan as a percentage of value, LPV, or loan as a percentage of the cost, LPC. Okay, so some financial institutions, they will have what they call the LPV and the LPC. And so, for example, let's say that the difference between the two, between the loan as a percent of the cost or the loan as a percentage of the value. Okay, so if you have a, let's say you have a lot, an undeveloped lot that is worth $100,000. Okay, so it's valued $100,000. It's been appraised at $100,000, but it's being sold for $95,000. Okay, so that'll be your cost. So the value of that undeveloped property is $100,000, but the cost is $95,000. You got that?
Okay, repeat it once more.
Okay, so we have an undeveloped property or undeveloped lot that is valued, that has been appraised at $100,000. Okay, the person who owns that is selling it for $95,000. So they're selling it for $5,000 less than the value. Okay, understand that so far?
Yes, sir.
Okay, so your value of that lot is $100,000, but the cost to the purchaser is $95,000. So there's two different. Okay, now it could be that the cost, the person who's selling it may also want to sell it for $100,000. Okay, so in that instance, your cost and your value would be the same. Okay, so if it's valued 100,000 and they're selling it for 100,000, the cost and the value would be the same. So there's no difference. So there's no problem when that happens. Okay, the challenge comes when you have a difference between the value and the cost. Okay, so in this instance, someone comes to me, the buyer, the proposed buyer of this lot. He comes to me as a bank, and he says, I want to get a loan to purchase this property. Okay, the property is valued at $100,000, but it's going to cost me $95,000. Okay, so if the bank then says, okay, you have to come up with 10%. Okay, the bank would then look at the lower of those. So look at $95,000, the cost, as opposed to the value. Okay, because while something may be valued at a certain price, the cost, which you actually pay for it, then becomes basically the new value. Okay, so what the bank will do is the bank will lend based on the lower of the purchase price or the value of the property. In this case, the $95,000 is less than the $100,000 value. So the customer will have to come up with 10% of $95,000, which is $9,500. Okay, and so then the bank would then lend them the difference. What that means now is, yeah. So the customer would have to come up with $9,500, and the bank would lend the difference. Is that understood?
Yes, sir.
So I just put it there. So LPV versus LPC, what's the difference? Okay, LPV or loan to value. Some say loan as a percentage of the value or loan to value. They're interchangeable. Okay, mean the same thing. So that is the loan as a percentage of the value. Okay, the V tells you what it is. V, value. And then the C and LPC, the loan as a percentage of the cost or loan to cost value ratio is, again, the loan as a percentage of the cost. Okay, So LPV, V for value, and LPC or LTC, C for cost. So it's straight, pretty straightforward. Okay. So if we look at the example that's given in the book, well, first of all, it gives us the calculate the formula. Okay, so it's the loan amount as your numerator, the asset cost or value is your denominator, and you multiply by 100 to give you a percentage. So in our example, we have a Mr. Bethel. He owns a duplex that is valued at $250,000. Okay, and he's taken out a mortgage against a mortgage loan against it in the amount of $175,000. Okay, so in this instance, there's no cost. There's a value because this property isn't being sold. A person is using their present property or their equity in this property to get a loan. Okay, so Mr. Bethel owns this duplex. Duplex is valued at $250,000. That's your denominator. He's taken out a mortgage of $175,000. That's your numerator. So $175,000 over the loan amount over the asset value of $250,000 times 100 gives you 70%. Okay, so it means that the lending percentage, the loan as a percentage of the value is 70%. Is that understood?
Yes, sir. I got that one.
It's a loan amount divided by the value in this instance times 100 gives you your LPV. Okay. So let's look at Martin and Sherry roll. So you can pull Martin and Sherry roll out. Oh, incidentally, did you all get to print a copy of the full appraisal that I sent for Martin and Sherry roll? I sent a copy of the full appraisal.
Yes, sir.
Actually, sir, I didn't get an opportunity to print it. I downloaded it, but I did not get an opportunity to print it.
Okay, well, if you could, because we probably be looking at it a little later on. So if you could download it and refer to it when we get to that exercise, because I want to look at the actually it's on the very next page, components, page 47 and 48. We talk about the components of appraisals. Okay, so actually, okay, so let's look at Martin and Sherry roll. Let's do their LPV or LPC. Okay, so again, here we have our formula. Okay, so we say the LPC or LPV is the loan amount, and in this case we're looking at value, the LPV, because this is an existing property, so it has a value. It's not being purchased by anyone or being purchased even by the rolls. This is an existing property house, so it's a valuation that we're looking at. So we're looking at LPC with regard to the Martin and Sherry roll. So the loan amount, we get that from the mortgage loan statement, which is 76,935. Everyone sees that? That'll be your numerator. Everyone sees that?
Yes, sir.
Okay. And then our denominator would be the value. So we get that from the current collateral security value on our on the mortgage loan statement. Okay. And then this is what it looks like. Okay. So the LPC is 76,935 divided by 275,000 multiplied by 100. So we're looking at about 28%. Okay, so this is a very low, and that's because two things have happened. The loan has been in existence for 16 years, and the value of the property itself has appreciated because of things that they have done to appreciate it, plus some other stuff happening. Okay, to cause the value of the property to go up. Okay, so this is very good, a very good position to be in as a borrower. Okay. Any questions on that?
So you would always use the current loan amount.
The current, sorry?
The current loan amount, the principal.
Yes, you use that as your numerator, yes.
Okay.
And express that as a percentage of the value of the property.
Okay. All right.
Okay. Okay, so that's LPV, LPC. Let's look at equity on that page. Okay, so using the same example, it says that equity is the dollar value of the amount you equity is the dollar value of the amount you own in a real estate property, less any loan or other encumbrance outstanding against it. Okay. Now, what is an encumbrance? An encumbrance could be real property tax. An encumbrance can be a second mortgage at some other financial institution. An encumbrance could also be attached by the courts. So, for example, if someone pledged their property to stand bail for somebody, there'll be an encumbrance on that property until either the bail conditions have been satisfied or met. So, for example, if the person is found, if the person goes to trial and is found guilty, then they go to jail. The encumbrance against the real estate, the property would fall away. If they are acquitted, it also falls away. Okay, but as long as they are out on bail, the encumbrance should remain on the, or will remain on the property. Okay, so an encumbrance again can be a real property tax, or in the case of like condos, you'll have condo fees, because they take legal precedence as well, like real property tax. It could be a second mortgage or further charge at another financial institution on that property. And fourthly, it could also be a judgment outstanding against the owners of the property. So there's a judgment outstanding in the Supreme Court against the clients, that would also form a legal encumbrance. Okay, and those four that I just listed well, with the exception of the further charge at another financial institution. So it'll be real property tax or service fees. What was the other one? Is that the judgment? They will. Those are legal, and so before the bank can get their money, they would have to be paid. Oh yes, the third one was the court holding a charge against the property for bail. Okay, so those three are legal encumbrances, and they rank ahead of even your mortgage, even though real property tax may become outstanding after they've gotten a mortgage with you, or the bail matter came afterwards, or the judgment came afterwards. Those are legal encumbrances, and they rank ahead of a financial institution's mortgage. They must be paid first before. So if you have to sell this customer's property, you have to pay those things first before you pay yourself. Is that understood?
Yes, sir. Mr. Nordich, let me pick your brain for a minute. I see that the government is trying to initialize collections of real property tax. And I understand that the financial institutions are trying to comply with them. And if I'm incorrect, please let me know where they are adding it onto your mortgage should you have any outstanding real property tax at this particular point. I thought with the contract between two individuals where real property tax is the responsibility of one individual, that being the person who took out the mortgage. How is it that now the banks are being dragged into it to apply the said amount to your mortgage?
Okay, great question, right? Yeah, great question. Remember now, real property tax, like I said, is a first charge on a mortgage property. Even if that outstanding balance came after they may have paid all the outstanding interest up front for a couple of years, and then, several years later, they didn't pay the real property tax. If that real property tax remains outstanding, the bank is on the hook for that because one, it's the law. Secondly, and this is covered in more depth in our Mastering Mortgages course. That's a separate course that deals with all the different laws and the rights and stuff of mortgagors and mortgagees, right? Ultimately, if the mortgagor, that is the person who's borrowing, doesn't pay, it is the bank's responsibility to pay. And there are legal cases. There's case law and examples in the UK and that we use here in the Bahamas as well. Okay, because we use the UK law, the common law. So ultimately, if the client does not pay, the bank has to pay. So you'll find the banks will be reaching out to their clients and asking them to pay. Okay, and if they are unable to pay or unwilling to pay, then the bank will add that on to the mortgage. One of the other rights of the mortgagee or the lender on mortgages, they have the right to tack. Okay, that is the tack on charges. So they can tack on charges for insurance, they can tack on charges for maintenance, they can tack on charges for real property tax. Okay, again, a lot of all of this is covered in quite depth in the Mastering Mortgages course, which is a standalone course. So that is why the banks are doing it the way they're doing it. In fact, this isn't the first time that this has happened. Many years ago, in the first PLP administration, there was a minister of finance, the late Paul Adley. He was minister of finance for a while, and he was the first person who in government who enforced this and made people accountable in terms of paying real property tax. Since then, it has kind of waned away, but the government has flexed its muscle, and in recent times, and once again, and so that's why this is coming to the fore now. How it is dealt with by the banks, I'm not going to offer an opinion per se. I would have, I guess they said, if that's the only way to get to pay it by tacking it on to the mortgage, that means the monthly payment for those people is going to go up. Okay, and those who are having difficulty meeting their payments now will even have more difficulty. If it wasn't so much of an administrative nightmare, I guess the better way to handle it would have been to put it on some sort of separate account, and so it doesn't attract interest. But of course, again, the bank has a right to tack on the mortgage, so the bank is not going to give itself that additional headache. You can say, something, I just put on here. If you don't pay, then we go through the process, of selling your property, exercising our right of sale, selling the property, realizing the security, and clearing, first of all, what's owed to the government, and then secondly, what's owed to them if anything is left. So that's the way it is. Unfortunately, that's the way it is.
Mr. Nordich, I look back at when I heard the minister, I think he's the minister of State of Finance, Mr. Alkias.
Yes.
And he was talking about property tax. And I go back 10 years when the advent of the said value-added tax, and it was recommended to the government, with the PLP at that time as well, to seek after the property tax, then there would not be a need, because there was, based on their figures, there was some outstanding of $600 million.
Yes.
Outstanding for real property tax, which would have not put us in the bucket of value added tax. And here it is 10 years later, basically, we're looking at getting hit with value added tax. And I kind of disagree where it says it's an indirect tax, because you got to eat. So it's a direct tax. In my humble opinion, but I think
you're quite right.
I think that we have come full circle, and we've come full circle at the worst possible time economically. I think that we could have dealt with this a long time ago, and now people are in a position whereby they can barely afford their mortgage payments, much less having to deal with real property tax. I commend the government for going up to $300,000. It's an effort on their end, but I think we could have cut the head of this snake off a very, very long time ago.
And I agree with you. See, in the past, what they've been doing, they've been giving concessions. So if you come and you bring your account current, we'll shave off some money off the real property tax. In most instances, they would forgive the I guess it's the surcharge, which is really interest charge on outstanding amount. So they would forgive that. In some cases, they discounted some of the real property tax itself. I remember a client of mine several years ago owed quite a chunk. I think it was in excess of $100,000 in real property tax on a commercial building, and they had changed the purpose of the building to accommodate senior citizens, and in fact the government subsidized that senior citizens home, and the government also used to send people there and didn't pay. So the owner, like I said, is one of my clients. So we got together, we formulated something to the government, given that the current use of the property was, and has been for X number of years, for rather than just being income producing, it was senior citizen home, which is a necessity. And the owner at that time is not even taking a salary for themselves, an income for themselves, because they're trying to, and then of course the government itself had acknowledged by contributing annually, albeit, I think at the time it was $10,000. And they gave that $5,000 for the first 6 months, another $5,000 the second 6 months of the year, and then they were sending people there, from Sandilands and whatever it is, people who were elderly, who were left abandoned by their families in PMH, So we appealed to the government, and the government did reduce it significantly. And the government also increased their contribution from $10,000 a year to $20,000 a year. So it was worth it in that instance, appealing to the government. Mind you, we had to go all the way up. We had to go all the way up. At that time, the current prime minister was deputy prime minister at that time, or some other office he held. Some other office he held. And so we used our connections with him to prevail upon the government, and so he made a case to the government on our behalf, because the cabinet had to make a decision on it. So that person was fortunate, particularly given that they already had some sort of link to the cabinet, a significant link to the cabinet, and also some of the other the other considerations, like the use of the home and of the building, So, but that's where we are. Like I said before, the government would give concessions, but not everyone availed themselves of the concessions. And so that's why we still had that 600 million that Mr. Alkeeda spoke of.
Yeah.
Right.
Thank you, sir. That brings some clarity.
Okay, great stuff. Okay, so equity is any dollar value or the amount you own in a real estate property less any loan or other encumbrance that is outstanding against it. So using the same illustration with Mr. Bethel, with his duplex property is valued at $250,000. The loan outstanding was $175,000. So we subtract that from the value, and his equity is $75,000. Okay, so his ownership in that property, his outright ownership in that property, is $75,000. The bank owns $175,000. And said another way, okay. So the bank, since he owes the bank has $175,000 interest in that property, and he has $75,000 interest in the property. Is that as clear as mud or clear as water?
Clear as water and mud.
Okay, a little bit of both of these. Okay, well let's continue to look at Martin and Sherry rule. Again, using their figures to look at their equity, right? So so the current value of their property is $275,000, right? Everyone agrees with that? 275,000
What's the value?
Yeah.
current value, okay. And again, we got that from the bottom right of the mortgage statement, okay. So we now need to know what the outstanding is, so we get that again from that loan mortgage statement. The top left-hand side, 76,975. Okay, so we have the current value now. We have the encumbrance, which is the mortgage that they owe to the bank, the mortgage loan. Okay, and then we subtract those, and we get $198,065. Yeah, and that's because the value has appreciated.
So, Mr. Nodded, question. When they do a current evaluation or appraisal on your home, the bank only traditionally takes about 80% of the actual value, right?
Well, it depends. It depends on the financial institution. Okay. So what some financial institutions will do is they may do it both ways. They may discount the value by a certain percentage, or they may say we will only lend up to 80 or 85 or 90% of the value. So one way or the other, the banks will do it either by an adjusted value or a percentage of the current value.
Thank you.
Okay.
Yes,
we'll look a little bit more into that when we actually look at the appraisals, which is coming up in a moment. Okay. So we have the current value 275 less the encumbrance, which is the mortgage, 76,933, gives them their current equity of 198,000. So said another way, they own 198,000, almost $200,000 in this property, and the bank owns just under 77,000. So what they own in this property is greater than the amount that the bank currently owns. Okay. So again, we got those figures from the mortgage loan statement. Okay. All right. So let's move on to real estate appraisals. And see how we doing for time. Okay, got a little bit of time. We should be able to do the first part of this for real estate appraisals. So we look at our text, page 46. Okay, so there's three approaches, okay, to doing appraisals. There's a sales comparison approach, there's a cost or replacement value approach, and then there's the income capitalization or income approach. The short name is income approach. So what is the sales comparison approach all about? Well, there is currently no register of land sales in the Bahamas. And so this is not typically used here, although some appraisers may do so. But this is limited to their personal knowledge of recent real estate sales and not reliable. Okay, since this book was this edition was out, I think this goes back to 2017. But the Bahamas Real Estate Association, they keep a track of, or they have knowledge of some recent land sales. And the reason that they have that kind of information is that you'll find that, you know, sometimes if someone is selling real estate and they go through a real estate agent, it used to be they either used to have a multiple listing with all, or there was an exclusive. Okay, so even if there's an exclusive listing, which means none of the other real estate firms can sell that prop, is listed with them. Nowadays, they have what they call these multiple listings service or something like that. I think it's called MLS, right? And so if Glen Knowledge Realty or real estate company is selling a property and I have exclusive over that, but someone else from another firm, real estate firm, wants to sell that, then we will share we will share the sales commission. Okay, and more than likely I will get the larger portion of it. So let's say it's an undeveloped lot, which attracts normally 10% commission. So let's say, again, using $100,000 for simplicity, 10% of that is $10,000. So that's the commission. So as the exclusive agent, I may get 6,000 of that, and the person who actually brought the client in to get it will get the 4,000, or it may go 50-50. Okay, but that's an arrangement that is worked out among the real estate agents. For that reason, because of with the introduction of the Bahamas Real Estate Association, and then becoming even more active and involved in policing the industry, sales are registered or lodged with them, and so they have this kind of little database of land sales, mainly a lot of the larger property sales, right, the most significant ones. And so a real estate appraiser can tap into that if that appraiser is also a part of a real estate firm, or he or she is registered with the Bahamas Real Estate Association. They can avail themselves of that kind of information. And so loosely, you have appraisers now talking about the sales comparison approach for similar sales in the area, but it is nowhere near perfect. But it is not a registry of land sales. We do not have a registry of land sales in the Bahamas. So in my estimation, it doesn't offer as much value as using the second one, the cost replacement value approach, which was the most often used in the Bahamas up to several years ago. I don't know if any of you may recall, but there was the appraisers in the country, real estate appraisers in the country made some noise because first of all, it was just one of the Canadian banks who was trying to pressure, from the head office in Canada, pressure the local. Well, first of all, they was trying to tell the real estate agents and appraisers here how to conduct appraisals, and they wanted to do it on sales comparison approach. Okay, and the effect of the sales comparison approach kind of dumbs down or lessens the overall value, because cost value or cost or replacement value in the Bahamas is kind of high. And so what they were doing is they were trying to say, well, it may cost $100,000, but I can only get it sold for $90,000. So therefore we should be using only the $90,000. But but the banks had at their disposal that they could then just simply discount the cost replacement value approach by 10%. Okay, so they could say, okay, it's valued at 100,000, but we're only going to use 90% of it. Okay, but of the cost replacement value. Okay, whereas the sales comparison approach, okay, if you now base it on the sales comparison approach, and you start with 90,000 rather than 100,000, then you're taking and you discount that by 10%. You're taking off 9,000 from the 90,000. So now you're working with a value of 81,000 as opposed to 90,000. So what it has had the effect of dumbing down values. Okay, so it started out first with one of the Canadian banks out of Canada, the head office in Canada, and then you had the other two Canadian banks join them. All right. So now what we have nowadays is that we have the cost replacement value not being used by the banks. Okay. We have a sales comparison approach. So if you look at appraisals now, and as we'll see, I'll come to it later, but let me just say it now. And let me just go to the next screen, right? With these three different approaches, okay, the appraiser normally will use an average of the three approaches to come up with his or her final appraised value of a particular property, okay? So going back, the sales comparison approach may be one value, right? The cost replacement value approach may be a different value. And the income capitalization approach may be a different value. But there should be some, if they're done properly, there should be some correlation or similarities in the values. Okay, so there shouldn't be these big discrepancies. Okay, but what we find is that the cost replacement value approach is by far in the Bahamas the highest of the values. Again, because if you have to price, what will it cost to replace this property, this building or whatever it is, it is much higher than you could probably get for sales. And normally people will buy something for less than the value in real estate. Very seldom would someone buy it for the value. So if a property is valued at 100,000, very seldom you're going to find someone buying it at 100,000. You'll find them buying it at lower than that. So it may be 98, 95, 90,000. Okay, and so as a result of using the sales comparison approach, they wanted to, and they have found a way to dumb down appraisals in the Bahamas. Okay, and so the Bahamas Real Estate Association and also appraisers were making noise against doing this. One, because on the real estate agent side, it means that it was more difficult for people who wanted to purchase properties to qualify for loans. Okay, and on the appraiser side, the appraisers were charging a percentage based on the value of the property. So it means that they made less money on their charges for the appraisals. Okay, another twist to this is why that adds the argument for the cost of replacement value approach being the more prominent of them, is the fact that when you go to insure your building, the insurance company uses the cost or replacement approach. Okay, what is this property value now? What would it cost to replace this? Okay, so but we're in a situation now where most financial institutions, they will ignore the cost replacement value and then look just simply at that sales comparison approach, which again, I fault the real estate agents because they've gone off to college or school or whatever it is, learn how to do appraisals, and you should be using, you should be examining the three approaches and coming up with whether you use a straight average or you have one with more emphasis on the other, but you should not discard. Okay, you should not just blatantly discard. So I cry shame on the real estate companies and appraisers for giving in, primarily to these three Canadian financial institutions. You wanted to say something or make it? Yeah, go ahead.
Mr. Manager, I have a question. So in the appraisals, how like if you're purchasing a home, they would usually get, I guess, like sales price, I think it is, from maybe previous homes that were bought within the same area, would that be considered under the sales comparison approach or the cost
Yes,
replacement?
that would be where they get their figures for sales comparison approach.
Okay.
See? But see, for example, for example, I know of an appraisal that was done in the Palmdale area, okay, and this is more in the residential section of Palmdale, and they compared with the recent sale of a property on Collins Avenue. Okay, and also the recent sale of a property off Wolf Road. Well, hello, in no way in the residential section you could compare the unit price with the cost of a property sale on Collins Avenue. Collins Avenue is much more higher priced. Okay, off Wolf Road is a little less price per unit than the residential section in Palmdale. Okay, so hey, you are comparing apples with oranges. You're not comparing like with like. You see? So unless you have a whole subdivision that is just residential properties and you're comparing like with like, I can't see sales comparison approach as they're doing it now being legitimate. But it is what is happening now. Unfortunately, that's what's happening now. Okay, and financial institutions, for the most part, have accepted it. I don't know if there are any who will now be looking at the cost replacement approach. But the irony of it is, and the hypocrisy about it is, that we call upon our borrowers to insure it for the cost of replacement value. But we will not accept the cost of replacement value as part of our valuation. In the past we did, but now we don't. And that's, to me, that's, like I said, the hypocrisy and the contradiction of it all. Okay.
I guess that's a part of the bank making its money, in the sense of, if it's not what it would actually cost you, then that means that to replace it, then that means that you now have to come back to the bank.
Well, I think it had more to do with muscle.
Yeah, I think that's
if your head office is in Canada and three of the 50% of the commercial banks here are Canadian origin. Okay, and if their head office say this is the way it ought to be done, then you can comply. And if there's three of the bigger players in the industry, you know, one of them has a mortgage arm. Okay. One of them has a mortgage arm, which is a major mortgage lender in the country. Okay, and is governed by the parent company. So it had more to do with muscle than because if the banks really wanted to make more money, to me, I would push against it, because then you would have a higher replacement cost value. So you could lend more, and more people would be able to qualify. Yep. It is what it is. Okay.
Mr. Nordich, if I can chime in here, is it legal? Because this question was asked. Is it above board and legal for a financial institution to actually tell you which lawyers you can and cannot use?
No, they can't. Now, what they may do is they may have a list of approved lawyers, right? They have a list of approved lawyers that they use, and that's primarily that these lawyers probably have approached them to do work for them, and they've satisfied, for example, insurance indemnity,
Mhm.
right? So, so for example, you have your larger firms who could afford to have indemnity insurance of up to $1 million, whereas the single one man show, I mean, he might his indemnity insurance he could only afford 100,000. So if someone comes and they want, even though the single lawyer, maybe the person's lawyer, the borrower's lawyer, and they come in for $250,000 mortgage, he can't do it because he doesn't have sufficient indemnity coverage, insurance coverage.
Because I noticed, Mr. Knowledge, as well, they have their list of quote unquote approved appraisers as well. So they give you the pool
Yes,
attorneys and appraisers and don't look
yes,
favorable.
and again, appraisers who are, I'm sorry, go ahead.
No, I was like,
Sorry, go ahead.
this isn't right, because if I qualify and I have my attorney and my attorney is not doing business currently with you, what's to prevent me from getting a mortgage? And if my attorney has somebody that he trusts in regards to an appraisal, and that's not on your list, it will not inhibit me from having a business relationship with your institution. And I often ask the question.
Okay, so let me deal with the attorney thing first. Like I said earlier, the bank cannot prohibit you from using your own attorney. However, if your attorney does not have sufficient liability insurance coverage for the amount that you were borrowing, so in the instance I gave, if the attorney, his firm only has $100,000, but his client is coming from loan for $250,000, that lawyer cannot do the work because he does not have the sufficient liability insurance coverage, right? So that is one of the things that drives it. Okay. Secondly, with regards to the appraisers, again, the bank will, the bank looks at the appraisers. They have certain qualifications that they require to be presented before they would put them on their list of accepted appraisers or inspectors. And to me, that makes sense, because there are some instances where there are some attorneys and appraisers who have done blotched jobs in the past, and so the bank has taken them off their list. You see, I'm not talking about a one-time, but it depends on how serious the one-time blunder was. But you would find that if you see that this is like a history, that this is an ongoing thing with this particular law firm or lawyer or this appraiser, you strike them off your list. To me, that's perfectly understandable. But I don't think any appraiser or any lawyer on the surface should be prevented from providing services on behalf of their clients or people who they know with any financial institutions. Like you said, there are exceptions, because if the bank had bad experience with a lawyer or a law firm or an appraiser, you ain't want nothing to do with them, and but you don't relate that to the client. You just say simply, and this is sometimes where the pushback comes, right? Because if there's been a bad experience, the bank is not going to tell them, oh, we had a bad experience with this appraiser, so we can't accept him or her, right? Or this lawyer or that one, because then they may be subject to libel, right? So it's a catch 20 situation for the banks. I have my thing with I've been in the banking industry for quite a while. I have my pet peeves with the bank, but in this instance, I could understand, particularly from a credit risk point of view, and I have spent almost 50% of my time being credit risk oriented, adjudicating and that sort of stuff. So, it may sound unfair, but when you dig down deep, the banks, as long as they're following criteria and not discriminating, I don't see any problem with it.
Duly noted, sir.
Okay. So the cost replacement value is the most often used in the Bahamas, especially for construction projects, and because they are cost priced. For properties where there's an existing building, depreciation is a factor in determining the final value. Okay, so where there's concern, and this is another argument for using the cost replacement value, because where there's depreciation will factor in the cost of replacement value in any event. Okay, then you have the third approach, which is the income capitalization approach, or the income approach. And this is used primarily for income producing properties, such as duplexes, triplexes, commercial buildings, etc. And this is also used in the Bahamas. Okay, now where you may find that the three approaches may not be used in an appraisal is if it is not in an area where that property could attract income. Now, a lot of that has changed because in a lot of strictly residential areas, people are using their homes, their residences, for Airbnbs. Okay, so there's certain sections of Cable Beach where there were residences and strictly residences, but the people are using them as Airbnbs, getting income. So in those instances, the income capitalization approach can be used or should be used as one of the appraisal approaches. Okay, so unless it is absolutely totally forbidden, you would definitely have the sales comparison approach and the cost replacement value approach in all of your appraisals. The ideal is to have the three of them represented. Okay, any questions on that?
I'm good, sir.
Okay, so it says the appraiser will use an average of the three approaches to come up with his or her final appraised value of a particular property. The values of each approach with respect to a particular property should be about the same value. This is a point I was making a bit earlier. That is, no major differences, say about more than 5 or 10% among the three different appraisals. Okay, now where you find that there's a big discrepancy, I would say, when you're looking at more than 10%, say 15 or 20%, then something is wrong with one of those methods, right? Or something is wrong. Let me just say, something is wrong. Okay, if there's a great big disparity. All right. So the example is that is used in our book. It says, for example, if the sales figure is $225,500, the cost replacement figure is $235,000, and the income figure is $221,750. These are fairly close and will usually result in a final value of $227,000 odd. Okay, using the simple average of the three approaches, or two as the case may be. Okay, so for example, if there's no, if this is an area where they're absolutely forbidden to do any income producing properties, any commercial properties of any kind, including Airbnbs, then they'll use the sales comparison approach and the cost replacement value approach. So it'll be at least two out of three. Okay, ideally, again, you want to use three. Okay. So any question on that?
I'm good, sir.
Okay. So again, I have this in red because that has changed. So I'm not going to go through that. the VAT on legal documents. But what we would I would do is, I won't get into any a lot of detail. The next class we will do an exercise on real estate components. Okay, so we'll be looking at page 47. This is 47, 47 and 48. No, I got my pages wrong. Sorry. Yeah, 47 and 48. Yeah. Yeah, so we'll be looking at page 48 and yeah. So page 47, it has the different components of appraisals. So I'll just read through them, and then I'll go through them in a little bit more detail, some more than others in next class. We'll begin next class with this. So so an appraisal should contain the following components: the date the appraisal was conducted and by whom requested, a legal description and physical location of real estate being appraised, along with a plot plan, the physical dimensions of the land, including confirmation that boundary stakes are in place wherever practical, the dimensions, age, physical condition, structure, structure or building type, including the roof, description and usage of rooms, the structure usage of any buildings on the land. 5, the description of any other physical improvements to the land, including patios, gazebos, pools, sheds, parking, landscaping, boundary enclosures, etc. 6, the description of any defects or limiting conditions to any of 3, 4, or 5 above, quantified in monetary terms where necessary. 7, pictures of the improvements outlined in 3, 4, and 5 above, including internal and external. And there's some minimum qualifications that appraisers must meet in terms of providing pictures. Okay, we'll talk about that in the next class. It must contain information about the neighborhood, that is trends, value range of properties, distances from essential services, hospitals, schools, shopping centers, districts, etc. Okay, that thing about trends and value ranges of properties, that's very important. Again, we'll look at that in next class. Confirmation as to the legal zoning for the use of the land, that is whether it's commercial, open, or strictly residential, including the highest and best use for the subject property. Confirmation of the availability of utilities and services, such as electricity, water, sewage, septic, waste disposal. It must be supported by reproduction, income, and market data estimates relative to the type and age of the building, desirability of the location, transportation, facilities, etc. There must be a confirmation that the appraiser has physically visited the subject real estate, him or herself. There should be a brief resume of the appraiser, including qualifications. I've seen some where the resume is longer than the appraisal. A declaration, they don't need any more than a page, half page, whatever it is. Some of them go into 3 and 4 pages. Declaration of the fair market value of the real estate, that is the dollar value of the property. 15, declaration that the appraiser has no interest in the property, present or contemplated, direct or indirect, and that is to avoid any conflict of interest issues. We'll again talk about that next class. And then finally, the signature of the appraiser. Okay, so there's 16, at least 16 components that are essential for when you are examining an appraisal that they should contain. And what we'll do at the beginning of next class, we'll, if you haven't printed that appraisal, could you print it for next class? The Martin and Sherry Roll appraisal, we'll be going through that in the exercise with the tick sheet that's on page 48. Okay, We just, okay. Any questions before I?
No, sir.
Okay. So I'll be sending the homework assignment after class. I'll also send the PowerPoint presentation. Okay. In addition to that, here are some important dates you may want to write down somewhere. So the last class is August the 25th. Our last class will be August the 25th. And usually in my last class, I do a review of key areas. And that's based on what has happened with the homeworks, the quizzes, the assignments, etc. In your case, not a midterm, but a mock midterm that we did as a homework, where I think the emphasis needs to be placed, or if students request me to look at a certain area. So the last class again is August the 25th, which will be a review class. We'll go through some of the stuff that we've covered in the course, and get you prepared for your final exam. Okay. And speaking of final exam, the final exam will be on September the 1st. Okay, so the following Thursday will be the final exam. Okay. So everyone has those dates?
Yes, sir. Mr. Knowledge, will the exam be at the institute or will it be online?
I'm not certain. I can find out. I can find out and get back to you on that.
Okay, sir.
All right. But again, the final exam will be, the true, false, multiple choice, fill in the blanks, and of course, a case study type question like Martin and Sherry rule. Okay.
Knowledge. When you find out, can you let me know too, please? Because I don't live.
You'll be fully
That's all.
equipped to mash up any exam I throw at you. All right. So, like I said, if you follow the end of chapter questions, you do your homeworks, you've done the mock exam, the in-class assignments, the in-class case study with Martin and Sherry rule, you have nothing to worry about. From what I see, none of you should have difficulty passing the exam, from what I've seen from the work submitted thus far.
With regards to the exam, I believe it would be at the institute, because the last certificate course I did, we had to go to the institute, and those that weren't in New Providence, they had to email Mr. Pratt in advance, so that they could have set up a testing center on, I guess, whatever island they're on.
Yeah. Well, I mean, whether it's in on site, we have students who, like in this class, we have someone from Abaco. So obviously, arrangements are made for instances like that. There's another course, not not to do with this, but one of our international courses, we accommodated people in Jamaica
Mhm.
doing one of our international certificate courses. So so we well, I say in we because I'm only part-time. The institute is capable of doing online or in person.
Okay.
But I will check and I will confirm. Okay.
All
Yes.
right, thank you.
Okay. All righty. Well, if there are no questions, that's it for tonight. And so look forward to my email, and I'll see you next Tuesday. Well, Tuesday coming.
Okay, sir.
All right.
Okay, good night.
Oh, incidentally, I didn't have time to scan your papers. So I'll get that done tomorrow and email those to you. Okay.
Okay.
Okay, sir.
No, that is the mock exam ones. All right.
All right, sir.
Okay. So good night, everyone.
Good night, sir. Good night, everyone.
Okay, good night.